Alright, for this video we want to go through a Form 1040 Schedule A for itemized deductions, and specifically we want to be looking here at the home mortgage interest deduction reported on line 8A. So in this scenario, our taxpayer here, he has quite an expensive house and he has a large mortgage on the property. And so because his mortgage exceeds the threshold for the year, which is $750,000 of average outstanding balance, he actually is limited in the amount of mortgage interest that he can deduct. And so we'll have a look at how he calculates that limitation and ultimately reports it on the return. We've got one slide here, just very brief, discussing this mortgage interest deduction limit and more details on the fact pattern. So taxpayers generally, when you have a principal residence and you pay mortgage interest, most people deduct all of it, right? There's no limits that apply. However, if you have quite an expensive property and the average mortgage balances exceed $750,000 for the year or $375,000 for married filing separate, you have to limit the amount of mortgage interest that you can deduct as an itemized deduction. Now, there's an increased $1 million threshold for grandfathered debts that were originated before 2017. But in this case, we're going to look at an example where he had a mortgage set up in Jan 2019. Now, the easiest way to calculate the average mortgage balance is using the first and last balance method. So it's one of a couple. Basically, you just take the mortgage balance at the start of the year, the end of the year, and then divide by 2, and that's your average, right? So it's pretty straightforward. So in this example, we have John taxpayer. He's a single filing taxpayer and homeowner in Sarasota. His 1098 shows that he paid mortgage interest of $66,595, and the outstanding principal balance on the 1098 was $1.14 million at the start of the year. The mortgage origination date was in Jan 2019, so these grandfathered increased thresholds don't apply. So if we have a look at his 1098 a little more closely, we've got it issued here from the bank for the 2023 year. So the total mortgage interest he paid was $66,595. We have a Jan 31 mortgage origination date, and the outstanding principal in box 2, this is at the start of the year, so $1.14 million. Now, when we look at his tax return, there is a worksheet that you can complete. This isn't filed with the return. It's just used so you can calculate the average mortgage and then how much interest is actually deductible. Now, this box here, I've added this just so we can go through the calculation, but this isn't part of the worksheet. It's just my math here. So in part 1, the qualified loan limit, so it does ask, if we had grandfather debts, that $1 million limit would apply. But in our case, we're just jumping down to box 7, where we enter the average balance of all of our home acquisition debt incurred after December 15, 2017. So in our case here, what we have is, BOY is beginning of year balance, EOY is end of year balance. So we add up beginning of year, end of year, divide by 2, and that's our average balance for the 2023 year. So we input 1.13 million there. 750,000 is the threshold for the year. So line 9, enter the larger of line 6 or line 8, and that's our $750,000 figure. And then all the loan balances that we have outstanding on an average basis is, again, that 1.13 million. Now, the qualified loan limit is the $750,000 for us. And so now we move into how to calculate the deductible amount of the home mortgage interest. So we've got our 1.13 million. The total interest that we paid is that $66,595. So on line 14, we divide the amount on line 11 by the amount on line 12. So we have the threshold divided by the average loan balances, and we're left with 66.3%. So we take our 66.3% times the interest that was paid, and we're left with the deductible portion of $44,152. So the $44,152 is the amount that is going to be carried over to Schedule A. And so if we jump back to Schedule A for us, we can see that that's the amount reported here on line 8 as deductible interest. Now, the calculation would be done a little differently if you had things like a home office right? Those computations would be separate and apart from that. But in this scenario, we've got just a homeowner with an expensive home, high mortgage balance, and so he's got to limit the amount of deductible interest that he is paying on Schedule A. Now, each state has different rules too. So this taxpayer is in Florida. There's no state income tax, but some states will not have that limitation imposed, and so it really just depends on where you're living and where the property is located. So, all right, so that covers it for this video. Hope that was helpful. Any questions, feel free to leave a comment below. And as always, I appreciate you watching, and I look forward to seeing you on the next one. Thank you.